Hello everybody, and thank you for joining us for our Super Changes webinar. Now the reforms, the major reforms, the biggest changes really in the last 10 years, most of these were announced in last year's budget. There's been some adjustments since then with a little bit of politics going on backwards and forwards. Finally, we got legislation through late last year, which really only left about 7 months for implementation of most of the reforms. And obviously now the clock is ticking, with just over 3 months until 30 June, so a little bit of work to be done. Now, whilst the changes can be frustrating, super is still a fantastic investment structure. It's generally the best tax structure. We've got concessional tax treatment, generally provides the best asset protection as well, so it's generally safe from creditors, bankruptcy, etc. For the vast majority of people, sort of paying a maximum of 15% tax in accumulation and tax-free in retirement. It's still a tax haven in retirement for the vast majority of people. So it's certainly not all doom and gloom. In fact, a lot of the changes are fairly positive, despite what you may have read in the press. You may have to adjust your strategies though, and maybe seek some advice or further advice if you've already had some advice in the past. But much better to do this than fail to comply with the new rules or maybe miss out on some of the opportunities available. So in this webinar, we will be covering off on the key changes and strategies for you to consider, and also we'll be looking at some of the changes and strategies specifically for SMSFs, and we'll have a little bit of a look at the end at what the next steps are, and we will try and answer some questions along the way if we do have time. Disclaimer there, this is general advice that doesn't take into account any of your individual objectives or circumstances or anything, so it's really important to seek advice before implementing anything. Now, the key changes at a glance, there was a lowering of the non-concessional contributions cap. There's a lowering of the concessional contributions cap. We've got the reduced threshold for the higher contributions tax. Now we're going to go through all this stuff in a little bit more detail. The new $1.6 million transfer balance cap, and this is one that did get a lot of press. The removal of the tax exemption for transition to retirement or TTR pensions. The tax offset for low-income earners has been extended. It's been renamed, but it's been extended. And deductions for personal contributions have been extended, which is really good as well. And also an increased threshold for the spouse rebate, which is another positive measure as well. So that's a snapshot of the changes. Now let's go through them all in a little bit more detail. So the first one is the lower cap on non-concessional contributions. So non-concessional contributions are your after-tax contributions. So you're not claiming a tax deduction for this. But they are a great way to get larger sums of money into superannuation. So basically the cap as it currently stands for the current financial year through to 30 June is $180,000, which is the annual cap. Now you also do have access to a bring forward provision. So you can bring forward 3 years. So 3 times 180 is $540,000. So you can get some quite large sums of money into superannuation, and this cap remains through until 30 June. The cap, if not fully utilised by 1st of July, so the bring forward cap will reduce. So just be careful of if you are caught up in the bring forward rules, or maybe you've triggered them in the past years, just to be aware that you may have a reduced cap. It may not be $540,000 if you've already triggered that. So just have a look at your circumstances and maybe get a little bit of advice. And also just remember, if you're aged over 65 on the 1st of July, then you do not have access to the bring forward rules. So just be aware of that when you're planning for your 2017 contributions and also your 2018 contributions. So the cap's reducing. The new caps are going to be $100,000 as an annual cap, and we still have access to the 3-year bring forward rule, but now it's 3 times 100, which is only $300,000. So just be aware of the reduction in the caps, and also be aware of the age 65 amount there if it affects you. Now, there's also some rules around the ability to make non-concessional contributions once your balance, your account balance, reaches $1.6 million. So $1.6 million, this is tied back to the transfer balance cap. which we're going to go through in a little bit more detail later on. But as you start to approach $1.6 million, your ability to access the bring forward rules and your ability to make non-concessional contributions at all get reduced. So basically, once you get to $1.4 million, the bring forward rule starts to get restricted. So under $1.4 million, we've got the bring forward rule, which allows us to do $300,000, 3 times 100,000. Between 1.4 million and 1.5 million in super, you only get 2 times the annual cap, $200,000. Between 1.5 million and 1.6 million dollars, you only get 1 times the cap, being $100,000. So this, and when we're talking about the $1.6 million, that's your total superannuation balance, all funds in pension accumulation. So just be aware of those as you approach those caps as well. Now, if you do happen to exceed your caps, you can choose to withdraw the excess together with 85% of the associated earnings of that excess, which is the earnings in the fund less the 15% tax the super fund would have made. And 100% of those earnings do get included in your assessable income, but you do get a 15% tax offset for the tax the super funds paid. Now, if you do not choose to withdraw, then the excess contributions will be taxed at 49%. So just be aware of this one. If you do accidentally go over your caps, you will get a notice. Just do not ignore it. You need to act on it, otherwise that excess will get taxed at 49%, which would be a bit of a disaster for you, given that non-concessional contributions are already after-tax contributions. You've already paid tax on them. To be slugged with another 49% would be a disaster. So if you do get a notice, don't ignore that. Okay, so just to summarise around the non-concessional contributions and the key points, the current cap continues to apply till 30 June, which is $180,000 with the bring forward of $540. The contributions get reduced from 1st of July 2017. So, and for those of you in the transitional period, if you've already triggered your bring forward rules in the last couple of years, you will have a different cap. You just need to be aware of what that is and find that out. And once you have more than $1.6 million inside of super, you won't be able to make any more non-concessional contributions at all. You'll be sort of locked out of that system. So just be aware of that as your balance starts to get up, and also be aware that once you get over 1.4 million in super, the bring forward rules start to get reduced as well. So just be aware of all those key points around the non-concessional caps. Now, some of the strategies to consider around the non-concessional contributions, just have a look at prior to 30 June and whether you can access the higher cap, the $180,000 or the $540,000. So do you have the ability, some cash to contribute perhaps? SMSFs, you do have the ability to contribute other assets other than cash, which we'll talk a little bit more about later on. And also, should you borrow to contribute? Maybe there's some age-based reasons to access the bring forward rules why you can now, the larger contributions amount. Maybe you'll have cash in, say, July and not in June, but you want to access the cap. So there might be some valid reasons to borrow to do it. We're not saying to rush out and do it. It'll be a personal circumstance thing, but just some other strategies to consider there perhaps. Review contribution strategies. If you are over 1.4 million or even approaching $1.4 million, and being aware of those reduced bring forwards, and also obviously over 1.6 million you can't put any more in. So just be really careful of as you approach those caps and work out what your strategies are going to be around that. And perhaps consider some recontribution strategies. We will talk quite a bit throughout this about equalising balances between spouses. So if one spouse has more than $1.6 million in super, it may be beneficial to have a look at a strategy to equalise the balances with a spouse who has a lower superannuation balance. So trying to get you both down below the $1.6 million rather than one person have a heap in super and being locked out of the system a little bit. So maybe just consider some of those strategies about recontribution using the non-concessional contributions, especially before 30 June when we do have the higher caps. Let's move on to concessional contributions. So the caps on concessional contributions have been reduced as well. So concessional contributions are your contributions basically which a tax deduction has been claimed. So typically these will be your employer contributions, including the SGC, any salary sacrifice, and personal contributions where a tax deduction has been claimed. So the cap for everyone is reducing to $25,000. For the current financial year, the 2017 financial year, it's $30,000 for those who are aged under 50 on 1st July 2016, and $35,000 if you're aged over 50 or over at that same date. So once again, we've got a higher contribution cap in the current year and reducing on the 1st of July. So just be aware of those caps, that they will be the same for absolutely everyone. Now, if you do exceed the cap, the amount over your cap will be included in your assessable income and taxed at your marginal rates. So that's not really a disaster there because especially if it was a salary sacrifice or something, if you hadn't salary sacrificed, it would have been taxed at your marginal rates anyway, so it's really just reverting you back to the situation that would have been. Now, you can choose to withdraw up to 85% of the excess, which once again is the amount less the 15% contributions tax that your funds notionally withheld, or you can actually leave it in super. Now, if left in super, then the excess will count towards your non-concessional cap. So it is probably easier just to leave it in super, but just be careful how this interacts with your non-concessional caps and the bring forward rule. So if you've already maxed out your non-concessional caps and then you exceed your concessional caps, if you don't withdraw that excess counts towards your non-concessional caps, which you've already maxed out, which will mean you'll be over your non-concessional caps as well. So just be careful how it interacts. If that's not an issue for you, yeah, it can be easier just to leave it inside the superannuation environment. Now, the personal concessional contributions, let's jump slides there. Personal concessional contributions, the deductions for this has been extended. Now, this is a really, really good thing that's come out. So basically the 10% rule's been removed. So as it currently stands, in order to claim a personal tax deduction for super contributions, less than 10% of your income has to come from employment, which is typically salary and wages. So this is very restrictive for people who maybe go from employment to self-employment or vice versa, or even employees later on in the financial year who maybe get a large capital gain or something and want to do something. Their only option is to salary sacrifice, obviously, which employers don't have to offer anyway, offer salary sacrifice, so very restrictive for employees. So with the removal of this 10% rule, basically everyone will have access to the caps, being able to maximise their caps and make personal concessional contributions and claim a tax deduction. So look, we've long been an advocate for the removal of this rule. We just think that everyone, regardless of your employment arrangement, should be able to utilise your caps, which is great. Now, this is a good method to bump up your superannuation, maybe deal with some capital gains, some bonuses, etc. Even at year end, it's going to be great for people who potentially have fluctuating income throughout the year. If you do have some cash flow at the end of the year and you haven't already maxed your caps, you'll be able to throw it into super and get a tax deduction. So a really positive change for this one, and provides a lot of flexibility. Now, just be careful that if you are making a personal concessional contribution, there is some paperwork that needs to be done, submitting a deduction notice, getting a response from your super fund, and there's strict time frames around this, and if you don't comply with that, then you miss out on your tax deduction. So just be careful of that. So this one applies from the 1st of July 17. This is not something you can do in the current financial year, but certainly something to consider in your planning for the future financial years. Okay, so the key points on the concessional contributions. Changes, the concessional current caps continue to 30 June 17, so that'll be $30,000 or $35,000 depending on your age. The reduced caps apply from the 1st of July 2017, so that'll be $25,000 for everyone, and the ability for everyone to claim a deduction for personal concessional contributions as from the 1st of July 2017, so that's a good one for everyone. Now, some strategies and maybe a little bit of an action list here around concessional contributions. So the caps change on 1st of July. You may need to adjust your current strategies, particularly reviewing salary sacrifice arrangements to make sure you fit in with the new cap on the 1st of July. these maybe need to be reduced. If you've been targeting your cap of $30,000 or $35,000, you'll have to reduce this. Now, we suggest you act early on this, so speak to your payroll departments and those types of things. Allow time for payroll to process the changes, or even before 30 June, a strategy for the current financial year. If you haven't already reached your caps, maybe you want to target them over the last few months and get a higher salary sacrifice going. Can you maximise the higher caps in 2017? Potentially, if you pass the 10% rule, you can make some contributions. So maybe you've got the opportunity to throw a bit of money in the next few months and get a tax deduction for that. Or if you're doing it via salary sacrifice, you'd better get onto it, because you'll need to speak to your payroll and get that in place beforehand. Having a look at the benefits of salary sacrifice versus personal concessional contributions. So as from 1st July, when everyone has access to the personal concessional contributions, just have a look at which one's going to work best for you. And some employers do reduce the SGC amount they pay if you're salary sacrificing. So if your employer is doing that, then you're probably better off using personal concessional contributions rather than salary sacrifice. And so just have a look at that. Also, you may just like the greater flexibility of personal contributions. You can make them when you want, when cash flow permits, especially if your income fluctuates. Maybe you get a lot of commission or lump sum type payments throughout the year. Or it could be a capital gain. You might sell an asset, sell a property or something, and want to manage the tax along those lines. Or maybe you've just come into some money, got an inheritance or something, target your caps, get the tax benefits of that. And it also may be easy to manage the cap with personal concessional contributions rather than with salary sacrifice. It's often hard to judge the exact amount to sacrifice to hit the cap, whereas by making personal concessional contributions, you can probably manage that a little bit more as well. With concessional contributions also, if you've got an SMSF, consider the double deduction strategy. We will go into this in a little bit more detail later, but have a look at that one. If you want to try and access twice the tax deductions in 1 year, that's a great strategy. Only available if you're in a self-managed super fund. For the employers who may be listening in, encourage your employees to review any salary sacrifice arrangements now, and maybe even notify those that you know are currently putting in more than $25,000. Just do that so you don't want your payroll to get inundated in the last week in June or early July with lots and lots of requests. So maybe just get on the front foot. If you do need more information or help with this with your employees, just look, feel free to circulate the webinar or let us know. I'm sure we can help you out there as well. Okay, the next change is the reduced threshold for the higher contributions tax. This is known as the Division 293 tax. Basically, this is additional tax paid on super contributions for higher income individuals. So basically, at the moment, anyone with adjusted income of up to $300,000, the concessional contributions go in from the employer typically, and the fund will pay 15% tax on that. Now, anyone with adjusted taxable income of above 15%, above $300,000 will get taxed an extra 15%, which is effectively 30% tax on their super contributions. Now, this threshold is reducing to $250,000 as from the 1st of July. Now, the tax gets assessed to the individual. So the individual gets the tax bill, not the super fund, for the extra 15%. Now, this tax amount can be withdrawn from super, but obviously that's you taking money out of super. So generally, given the lower contribution caps, which is effectively a lower ability to get money into super, if you can afford the tax bill, you may be better off just paying it, the assessment yourself, and leave the balance in super, but you do have the option of withdrawing the amount as you can. Now, just quickly, adjusted income is basically your taxable income, which is your assessable income minus deductions. They add back reportable fringe benefits and any net investment losses, and also any reportable super contributions, which is typically your salary sacrifice and personal contributions. So it is adjusted taxable income, so just be aware of that if that does affect you, that the threshold is actually reducing. Now, some other contribution changes. The spouse offset, nothing new here except the threshold's gone up, which is a really, really good thing. So the threshold, currently the threshold is 13,800. So if your spouse earns more than 13,800, you're not eligible for a spouse contribution. This is actually increasing up to $40,000, which is a big jump, and this is a really, really good measure. So basically, you can get an offset of up to $540, which is an 18% offset. So you contribute $3,000 into your spouse's super fund, you get $540 back in tax. So it also helps, apart from the little tax benefit there, it also helps equalisation of balances between spouses. Now, the low-income super tax offset, this is basically a continuation of the low-income super contribution, so they've basically just renamed it, but it's effectively the same thing. So lower income earners, if you've got income less than $37,000, you get a refund into your super account of up to $500 of the tax paid on the super contributions. So as your employer is making super contributions, the super fund's taking 15%, you get a refund of that tax back up to $500. The co-contribution thresholds remain the same. This is the super co-contribution where the government puts some money in if you tip some money in. So the thresholds remain the same. And there's also, you still must meet the eligible income test, which means 10% of your income must come from employment-related activities or carrying on a business or a combination of both. But there are two new eligibility criteria. The first one is your total super balance must be less than $1.6 million, and also that you do not exceed the non-concessional caps or your non-concessional caps in the current year. So there's just two little extra eligibility criteria around that. But the co-contribution, if you're eligible, is still a good one. You contribute $1,000, the government puts $500 in. You know, it's a 50% return on your money, reasonably easy return there if you qualify. Now, just mention the work test here. Now, there's actually no changes to the work test, but the reason to mention it is that in the original budget proposals, they were going to remove the work test, but that proposal was scrapped. So anyone aged over 65 who wants to make a contribution to super must pass the work test. So just be aware of that. And also, I'll just quickly mention the ability to carry forward unused concessional contributions. Now, this one doesn't come in until 1st July 18, and effectively that means it doesn't affect anyone until the 2019-2020 year, so it's still a fair way off. But just to quickly mention it, that if you don't use all of your concessional caps in one particular year, there are some eligibility criteria, but if you qualify, you can actually carry forward those forward for 5 years. So that'll be a good one, but it's a little bit far away yet to do any meaningful planning around that. Okay, the key points around contributions. The additional contributions tax threshold reduced, just be aware of that one. The upper threshold for the spouse rebate has increased, so that's a good measure. The low income super tax offset is continuing, that's a good measure. Just be aware of the new eligibility criteria for co-contributions. The co-contribution itself is still a good measure if you qualify, but just be careful of those two extra criteria, and just be aware that the work test remains if you are over age 65. Okay, so some strategy considerations and a little bit of an action list here. Division 293, look, if you're just an employee, there's probably not much you can do around this. However, for business owners, or maybe you've got a private trust or private company, you may be actually able to manipulate or adjust your income levels to remain below the thresholds with different distributions to different family members or some other strategies there. So if you are able to, maybe consider doing that and adjusting your income and fit below the new threshold. Review the spouse contribution eligibility. The new income threshold, it's gone up, so have a good look and see if your spouse can access that one, or you can access the spouse rebate yourself, and also the co-contribution. So have a look and see if you're eligible for it, and then obviously if you are eligible, have a look and see if you want to make some contributions there. Do you need to pass the work test? If you do, make sure you pass it. It's basically 40 hours of work in a 30-day period at any time throughout the financial year, so not overly hard to pass, but just make sure you do if required to do so. And also have a look at an overall contribution strategy. So what strategies are going to work best for you and your spouse? Assess all the different types of contributions. We've got concessional contributions, salary sacrifice versus personal contributions. We've got non-concessional contributions. We've got the spouse contributions, co-contributions. And really find the combination and the overall strategies which work best for you and your spouse tax-wise, but also obviously fitting in with the new caps and the new rules. The aim is still to maximise super. So you just need to have a look at all the different strategies and options available and find the one that works best for you. Okay, we're going to move on. That's all on contributions. We're going to move on to having a look at some income stream stuff now. And this is income streams basically when you start to pull money out of super, draw a pension. Now the transfer balance cap, this was a big one that ended up coming out, and basically this has been introduced as of 1st of July. The new cap effectively restricts the amount of savings that you can use to commence a super pension. Now just note that this is not a limit on how much you can have in super, just the amount that you can have to start a pension, and that the pension is the amount that effectively goes into that tax-free retirement phrase. So you can still have as much as you like inside of super. It's just a restriction on the pension component. So now just be aware the cap also applies to existing pensions. Now, if you've got an existing pension which is over $1.6 million, then this needs to be reduced by the 1st of July. Now, it's really, really important that if this affects you, that you actually need to take action, because existing pensions are not grandfathered. They need to comply with the new rules. Now, there are special rules. I'll just quickly mention this. There are special rules that apply to non-commutable income streams. Now, these are sort of lifetime pensions, annuities, sort of defined benefit types things, life expectancy pensions, and those types of things. So if you do have one of these types of pensions, you will need to seek some advice. There's some formulas to work out how much of it gets counted towards the cap and whether you exceed it or not. So if you're affected by that, once again, seek some advice. We don't have time to go through all the detail on those ones in this particular webinar. Now, if you exceed the cap and you don't rectify it, then basically you lose the tax-free status of the entire amount. So as it stands at the moment, you commence a pension, so your superannuation moves from accumulation phase into pension phase, and the earnings on those amounts are tax-free. And if you're over age 60, obviously the pension's coming out of tax-free, but the earnings within super are also tax-free. So now that that amount is getting restricted to $1.6 million, we can still have $1.6 million sitting in super, and the earnings on that will be tax-free. However, if you exceed the cap and you don't rectify it, the whole $1.6 million will lose that tax exemption and go back to being taxed at 15%. Now, any excess over the $1.6 million can still stay within super. It can go back to the accumulation phase and continue to get taxed at 15%. Now, the changes, as already mentioned, don't affect the tax you pay in your withdrawals, whether that's pensions or lump sum. They're still tax-free over age 60. We're talking about the tax within the superannuation environment in itself. So, look, $1.6 million is still a fair bit, and don't forget that's an individual cap. So really, for a couple, that's $3.2 million. Now, depending on your circumstances, you may not be anywhere near this right now and think that this just doesn't affect you. Now, even if you're not near the cap now, just be aware of it, because a lot of people hold insurances inside of super which could quickly put you over the cap. Now, this is probably a little bit of an estate planning issue, which we will touch on a little bit more shortly. But also, if you receive your spouse's super upon their death, that could also put you over. Also, potentially anyone trying to access the small business capital gains tax concessions, just be aware of the caps, because as part of your strategy to maximise what you can get in, we'll just need to be aware of those caps as well. So you may not be anywhere near there now, but there's certain circumstances which quickly could get you there or bump you over, so just be aware of that. If you are in an excess position, it's really important to talk to us well before 30 June so we can work through and sort out how much we need to potentially move back into pension phase or potentially even out of the super environment altogether. So certainly seek some advice there. if you do have balances above $1.6 million. Now, just a quick explanation of what counts towards this cap. So first of all, existing income streams, as I've mentioned, they're not grandfathered, so existing income streams will count towards the cap, and that will be the balance of those income streams on the 30th of June 2017. Any new income streams that you do commence will be counted towards that as well. And just be aware also, transition to retirement income streams do not count towards the cap. So more on these soon, but they're not going to count. So it'll be your existing income streams plus new income streams, excluding transition to retirement. Now, also what counts towards the cap is any reversionary income streams that you get on the death of someone. Generally, it's going to be a spouse. If that income stream reverts to you, then that will count towards your cap as well. So, and I've already mentioned that can quickly get you up. So we will need to review your estate planning and your circumstances, and having a good look at reversionary pensions versus death benefit nominations. There are different outcomes depending on which one of those you have in place. And ultimately, you still may want to maximise the amounts that can be retained in the super system because it's restrictive as to how much we can get back in. We've just gone through all the lowering of the caps on putting contributions back in. So I think the ultimate aim generally will be to try and retain as much as we can in the super system, and there's certainly some strategies around that and with estate planning. Now, be aware of the reversionary pensions and also insurance proceeds with the estate planning, which I've already mentioned. Now, the notional earnings on the excess also get counted. So if you've got an amount above $1.6 million, let's say you've got $1.7 million, you've got an excess of 100, the ATO will calculate notional earnings on that excess, that 100, and apply that to your cap as well. So not only are you over, you'll be over by more because they're going to keep adding earnings to it. So just be a little bit aware of that one. The ATO does do those calculations, but yeah, it will add to the excess amount as well. Now, there are amounts that actually come off the cap that reduce the cap. So any commutations you have, whether that's rolling some back to accumulation or maybe taking a lump sum withdrawal, they'll come off the cap. That's probably going to predominantly make up the most of everyone's withdrawals or amounts that come off the cap. I won't spend too much time on the last two, but basically there's structured settlement payments, which are payments for personal injury, structured settlements, lump sum workers' compensation, those types of things. And certain other payments as well, family law stuff, some fraud, bankruptcy, void transactions. All of those things are structured settlements and the other types of payments. If you have one of those events, then seek advice on those. Now, exceeding the cap, basically breaches of the cap will require the excess amounts to be removed. Now, this will most likely mean a partial or a full commutation. Now, that could be back to accumulation or out of super altogether. Now, the ATO will issue a notice that the cap has been exceeded, and that will also identify the excess. So this is not something you need to do yourselves. The ATO will issue those notice. Now, if you've rectified that, then you just let the ATO know, and that will be fine. If not, basically, the excess notice given by the ATO will give you 60 days to rectify that. Now, after 60 days, if you still haven't rectified it, the ATO will send a commutation notice out to the trustees of the super fund, giving them 60 days to do this, to rectify it. And now, if that's completely ignored again, then basically that's when you lose your tax status there, where the earnings of the assets that are supporting this pension will no longer be tax-free. They'll go back and being taxed at 15%. Their notional earnings get taxed at 15% for the first offence, 30% for subsequent offences. So, look, for anyone out there who's in a public offer fund, retail fund, industry fund, obviously the trustees will take care of you. I don't think they're going to ignore a notice from the tax office to comply with this, but for SMSFs, you will need to act on this yourself and potentially seek some advice around that. So just be aware of those excesses, and if you do get notices, don't ignore them, don't sit on them. You need to actually act on them and sort this out. Now, there are some transitional provisions for existing income streams. Basically, if you're in excess by up to $100,000 as at the 1st of July, then basically they're going to give you as a once-off 6 months to fix this without penalty. So if you are over, but certainly be aiming to comply with the $1.6 million cap by 30 June. Okay, moving on now to the changes to the transition to retirement income streams. So basically, under the current rules, a typical transition retirement strategy, rather than take all of your income as salary and wages and pay tax on that at marginal rates, people have been increasing their salary sacrifice into super, which means you pay a maximum of 15%, and then commence a pension, which you can draw out, and if you're over age 60, that's tax-free coming out. Now, from 1st of July, now the other thing to mention there will be is when you move from accumulation phase, start a transition to retirement pension, that amount is now in pension phase and the earnings are tax-free on that amount that's in pension phase. So as of 1st of July, the transition retirement pensions no longer get that tax exemption on earnings. So the taxation of the pension payments themselves do not change. If you're over age 60, they'll still come out tax-free. It's just the tax exemption on the earnings within super. Now, this will reduce and in some cases wipe out the tax benefits of a transition to retirement. Now, this will depend on each person's circumstances, so there's no blanket rule here. It will be important for you to just review and, if necessary, adjust your strategies. Now, there is a little example here which we'll just go through. So basically, we've got Mary, who's age 61, retiring in 4 years, earning $90,000, has $300,000 in super. So we'll go through, if she did not have a transition to retirement strategy, her super balance projected out would come up to about $433,000. Now, under the current rules, if she implemented a transition to retirement strategy, she would end up with about $21,000 extra in super by implementing a transition retirement strategy. Under the new rules, she is still better off. She's $14,461,000 better off than doing nothing. So between the current rules and the new rules, she's $6,000 worse off, but still better off than doing nothing. So it is important that there are many factors that affect this transition to retirement strategy and everyone is different. So get advice and work out whether this strategy still actually works for you. Okay, the key points around the income streams, that if you've got more than $1.6 million, you won't be able to commence any new income streams from 1st July 17. Existing pensions must be reduced to $1.6 million by 30 June. There is no grandfathering for existing pensions. Earnings on transition retirement pensions, they're going to be taxable from 1st of July, and if these changes do affect you, you do need to take action before 30 June or 1st of July. Okay, let's have a look at some strategy considerations around this. So obviously, review and adjust pensions to comply with the $1.6 million cap. You must act to comply. You can leave the excess over 1.6 in super, or you can take it out and invest it outside of super, or potentially take it out, recontribute it for a spouse, and have a look at an equalisation strategy there. So there's quite a few options. Maybe seek some advice around that as to which one is the best one for you. Generally, we're saying leave it in the super environment if you can, given the restrictions on getting it back in, but everyone's circumstances are different, so please seek advice around that. Transition to retirement, review the effectiveness of those. Look, they're potentially still valuable, but it will depend on your individual situation. So if you do have a current transition retirement pension, the most important thing is to come in and have it reviewed. Review the tax effectiveness of it, and potentially we can use an alternative type transition to retirement type strategy. There's some other strategies available that can give similar results, using a spouse and maybe using a full account-based pension as well. So there are other options there. Consider a recontribution strategy, maybe to equalise super, but certainly if you've got an excess over the $1.6 million cap. have a look at pension payments versus commutations and review how the method in which you take your income affects your $1.6 million cap. If you remember, we went through what comes off the cap. Commutations come off the cap, pension payments do not. So there's some probably strategy work to be done around that if you're in excess as well, and get some benefits from that. Review your estate planning, especially those reversionary pensions and your death benefit nominations, and just be aware of the impact those will have on your cap and what happens to those under the new rules. Equalising balances between spouses, both now as a strategy, but also if you are one of the younger generations as a longer-term strategy, making sure that you're fully utilising both caps, 2 individual caps, $3.2 million. Don't restrict yourself to $1.6 million by loading up one person and neglecting the other one. SMSFs, there'll be some capital gains relief for you. We'll go through that shortly as well. And also review your reserving strategies as well, if you have those. I'm going to go through both of those in a little bit more detail. Now, moving on to the self-managed super fund section. So basically, if you're going to be impacted by the changes, so this is the $1.6 million cap and the changes to the transition retirement rules, maybe you've got to move some assets back to accumulation phase, or you're in a transition retirement pension, so now the earnings on that pension are going to be taxed. Up until now, when you're in pension phase, the earnings, including the capital gains on the sale of any assets, is tax-free. Now, what did the changes mean? If you've got to move assets back to accumulation because you're above $1.6 million, or you're in a transition to retirement pension, the earnings are now taxable, you may need to pay some capital gains when you sell the assets. However, the government has provided some capital gains tax relief here, and basically you can elect to reset the cost base of your assets up to its current market value. So effectively you'll only have to pay tax on the future growth, not any growth that's happened up to date. So the acquisition date is also reset. So just be careful of this if you do opt to use this, this relief, that in resetting the cost base, your acquisition date is deemed to be reset as well. So just be aware of that. That will mean you'll have to hold the asset for another 12 months to get that capital gains discount. Now, you don't just take a blanket approach here and reset the cost base of everything. There's some eligibility criteria which the fund and the asset must pass. Now, there's also different methods for resetting the cost base depending on whether your fund is segregated and unsegregated. So if this affects you, you're really going to need to get some advice around this. So depending on the method used, this can be an asset by asset based decision. So it's not something you just, well, you may apply it to all assets provided they're eligible, but you can choose to apply it asset by asset. Now also some fund assets may be eligible and other maybe not. You may choose to apply it to some assets and not to others. So to basically work through it, I guess a little bit of a decision-making process here. 1, is my fund eligible? 2, is this asset eligible? 3, which method should I use? And then finally, do I elect to reset the cost base on this asset? Now, if I do elect to reset the cost base and it triggers a capital gain, there's another relief mechanism which allows you to defer that capital gain. Now, that's an election as well, so that's another decision to make. Do I elect to defer the capital gain? Now, the relief applies to ordinary account-based pension, also applies to transition retirement pensions, which the ATO has just recently confirmed for us. There was a little bit of confusion early on about this. So really need to look at the eligibility for relief and whether you should or should not apply it. It is complex. It will depend on how your arrangements are set up within your fund. The most important thing to do here is talk to us and get some advice, and do that sooner rather than later. So it does look like it's a nice little windfall for everyone to be able to reset their cost bases up, but it is a little bit of complexity around that, so certainly seek some advice around that one. Now, just to quickly finish off on this, so resetting the cost base is actually a deemed capital gain, so it will trigger a capital gain. But the question for your fund, is it a taxable capital gain? If you're, if you're in pension phase at the moment, then no, because pensions are currently not taxed. Sorry, the assets supporting the pensions are currently not taxed. The earnings on those assets are not taxed, so there'll be no tax there. Even if it does trigger a taxable capital gain, you can elect to defer that until the asset's sold anyway. So there's, basically there's no real tax consequences immediately, potentially, but certainly seek some advice around this. Now, just talk quickly a little bit about another change that's come in, is the anti-detriment payments have been abolished. So part of the super changes were to abolish this as from 1st of July. Now, in order to pay an anti-detriment payment, a lot of SMSFs established reserves to pay that. Now, with the abolishment of the anti-detriment payments, now these reserves don't necessarily have to be unwound. So they can be repurposed for other things and other strategies. So it's certainly, if you are running a reserving strategy within your fund, certainly be looking at getting some advice around that and what the best thing to do with your reserve is. As I said, they can be repurposed, and at the moment, you can use reserves to top up member balances, top up pension balances, and all those types of things. So there are some strategies around the use of reserves, but if you are running reserves, certainly come in and get some advice around that. Now, contributions reserve is another strategy that is only available to self-managed super funds, and this is where you can actually get a double deduction in one particular financial year. And I will go through this in a little bit more detail shortly, but that's another reason to use a reserve in your superannuation fund. I will come back to this one and explain in a little bit more detail. Now, another strategy to look at for self-managed super fund is the transfer of assets. So we spoke at the start of the webinar about having a look at the non-concessional caps and the ability to get large sums of money in. Now, if with self-managed super funds, that doesn't have to be a contribution in cash. You can actually contribute other assets. So self-managed super funds have the ability to accept transfers of listed securities and business real property, and they can come in as non-concessional contributions. So have a look at whether you've got other assets outside of super that you may want to contribute. Now, business real property is typically it's property that's used exclusively in a business. Now, this will be land and buildings typically, but also, think about farmland, most commercial types of properties, but can include some residential property if that property is used wholly and exclusively in a business. But obviously it's a little bit more trickier around residential property, so seek some advice around that. But perhaps if you've got an SMSF out there and maybe you don't have the cash to make a large contribution before 30 June, even though you'd like to, have a look at your other assets, maybe you can do that. So this is having a look at utilising the larger caps for 2017, so the $180,000 with the 540 bring forward rules. So moving assets into that super environment where it's concessionally taxed, and obviously it's a very, very protected environment from an asset protection point of view. Now, the transfer will be a capital gains event, so need to look at the other tax consequences, but also have a look at the other tax concessions that are available. Maybe you can access the small business concessions, maybe use a double deduction strategy. It's a good idea to seek advice before doing this, and also to understand if there are any other tax or maybe stamp duty implications as well. So now we'll go through that double deduction strategy, which I've mentioned a couple of times. Now, this strategy has not been impacted at all by any of the changes that are coming in, but I thought it was still worth mentioning while we're talking about, we talked a little bit about reserves, but also the transfer of assets into super, which may trigger a capital gain event. So you may be looking for a larger tax deduction. So self-managed super fund members have the ability to effectively claim 2 years' worth of tax deductions in 1 year. Now, this is done by using a contribution reserve. So basically, the fund can receive a contribution from a member, and the member claims a tax deduction for that contribution, but the self-managed super fund parks it in a reserve. Now, the fund then has until the 28th of July to allocate that out from the reserve to the member's account. Now, as it's allocated in July, it counts towards the member's concessional cap in the new financial year. not in the previous year. So it's great if you need a larger tax deduction in one particular financial year. Say you had a capital gain event, or maybe you're going to not need a tax deduction in a future year. Maybe you're retiring, going to have low income next year, but you've got large incomes this year and you want to access deductions. So now note that this will mean that you've fully utilised your cap for the new financial year. So whilst you get the double deduction in 1 year, you've used your caps for 2 years. So just be aware of that. Now, implementation of this is a little complex. So if you are looking to implement this one, get advice, come and see us, or give us a call, have a chat to us. Need some advice around it, plus there's some paperwork that needs to be completed to put this one in play. So just keep that one in mind if you do have a year, and it doesn't have to be done this year. I've used it there in the little slide there, 2017, 2018. You could use it next year, 2018, 2019, so just be aware of that one. Now, the key points around SMSFs is the capital gains tax relief. If you are impacted by the $1.6 million cap or the changes to the transition to retirement rules, you get some CGT relief there, potentially resetting your cost base of your assets. Have a look at the reserving strategies. The anti-detriment payments have gone now, but if you are running a reserve, just have a look at the strategies as to whether you're going to unwind the reserve or whether you're going to repurpose the reserve for other strategies. Have a look at transferring assets in, making large large non-concessional contributions prior to 30 June while we've got the larger caps, maybe even accessing those bring forward provision as well, and have a look at the double deduction strategy. Okay, SMSF action list and strategy considerations. It's basically everything we've mentioned throughout this whole webinar, and also seek advice. Obviously, SMSFs are a little bit more complex. You are doing everything yourself, so they are a specialist area, so please seek advice. Have a chat to us. Obviously, we're SMSF specialist advisors, so certainly happy to help out there. Okay, just a quick conclusion here. Look, there's a lot of change. You do need to work through your circumstances and understand how the changes impact you. And you may need to seek advice or even get further advice if you already had advice in the past, as some or a lot of your existing strategies may have to change with the new rules. Super is still super. It's a fantastic tax environment. It's a protected structure, so it really is ensuring that you are taking advantage of all the strategies available and making sure that you do comply with the new super rules. Now, the next steps. You do need to establish what you must do prior to 30 June and what adjustments you need to make to your strategies for the post-30 June environment. And you should also have a look at all of your strategies and see what else you can take advantage of. For existing BCG clients, we'll be following up all of you who have registered for this webinar over the next few weeks, and we will be contacting all of our SMSF clients anyway, regardless of whether you registered or not. So if you do have any questions in the meantime, please contact the office, and obviously we can help you out. Now, for those of you who are currently not clients of ours, that's fine. If you do have any follow-up questions or would like to talk about your super, or maybe you do need some advice, please email me. You can email me directly and we'll be in touch. The contact details will be up shortly. We are making a recording of this webinar, which we will distribute to all of those of you who have registered. We'll get it out to you as a priority. Please feel free to watch this as many times as you like, and also forward it on to anyone else who you know may be interested in it. We're happy for you to share it to as many people as you do like. Okay, so here's the contact details. That's my email address there, so please feel free to flick me an email with any follow-up questions, or if you do want to arrange a time to talk around it. You can obviously phone the office at any point in time, and there's contact us via our website as well if you want. There is a lot of other good stuff up on the website. So contact us with any questions or any help that you may need. Thank you for joining us, and we look forward to speaking with you soon.